Welcome. My name is David McCollum. I'm a manager with Cherry Bekaert's Credits and Accounting Methods team. And with me today,
Carolina Stevenson. I'm a senior tax associate here at Cherry Bekaert, also on the Credits and Accounting Methods team.
Today we're here to discuss a recently issued LB&I directive that provides a pseudo-safe harbor for the substantiation of qualified research expenses for the R&D credit.
Great. Thanks, Dave. So can you tell me what's recently happened for the R&D tax credit?
Sure. If we backtrack a little bit, some of you probably know this, but with the PATH Act enacted in December of 2015, the R&D credit was made permanent, and it created a couple of new avenues for the R&D credit. And it also enhanced it a little bit by allowing for the ability to offset alternative minimum tax, and for some companies, smaller startups, to offset some of their payroll liabilities. With that, we've seen the issuance of several pieces of guidance from the IRS concerning the mechanics for offsetting payroll tax liabilities. But most recently, the IRS issued a directive for its examining agents. It was a pseudo-safe harbor for the substantiation of qualified research expenses.
Okay, and who does this directive affect?
So it directly applies to LB&I taxpayers. And LB&I taxpayers are taxpayers who have $10 million or more of assets.
Okay.
So this directive is not going to bind the IRS's Small Business Self-Employed Division, and if you can't get it resolved at the examination level, it's not going to bind IRS appeals.
Okay.
So it's just going to apply to LB&I taxpayers and revenue agents that are in LB&I.
All right, good to know, good to know. And so who is an LB&I taxpayer?
Okay, so they have $10 million or more of assets. And, more specifically, the directive is going to apply to those LB&I taxpayers who keep U.S. GAAP financials, and those financials also have to have a line item or a footnote that complies with ASC 730 for financial statements for R&D expenses. And you're going to have to fill out several disclosure statements in order to get the benefit of this pseudo-safe harbor.
Okay, great. And so you already mentioned that this doesn't affect or doesn't bind other divisions within the IRS outside of LB&I in the examination, but there's probably some other lingering questions out there. Is this a true safe harbor? I know you say it's a pseudo. What exactly does that mean?
So I would say it's not a true safe harbor. I think you'll see some other accounting firms out there say that it is.
Okay.
I would say it's not because it's not actually issued in the form of a revenue procedure or a regulation.
Okay.
So what we have here is a directive which does not have the force of law, and which, if a case ultimately ends up in court, the IRS is not going to be bound to follow. The reason why I like to call it a pseudo-safe harbor is for a revenue agent to not follow the directive. They are supposed to get permission of the territory manager to not follow the directive, and there's going to need to be some compelling reason for that revenue agent to not follow the directive.
Okay. So we talked about safe harbor. We talked about who an LB&I taxpayer is. We talked about how this is within the IRS. Tell me how a taxpayer can claim this, be able to use this directive to their favor.
Okay. So, you're an LB&I taxpayer, you're keeping U.S. GAAP financials that comply with ASC 730. And then you've got to fill out 4 different disclosure statements. And these are the appendices A through D to the directive. Appendix A is essentially a certification statement.
Okay.
A, we follow the directive, signed by officer of the company. Appendix B is going to be a reconciliation of the Form 6765 that you report the R&D credit on your tax return to the adjusted ASC 730 amount. Appendix C is the computation of your adjusted ASC 730 amount. So that you're not just pulling the ASC 730 amount directly from your financial statements. There is an adjustment to it. There's going to be some subtractions and some additions. Probably the main subtractions that will go a long way in determining whether or not taxpayers want to use this are contract research expenses, either inbound or outbound. Those are not going to be included in your adjusted ASC 730 amount.
Okay. And
some capitalizable costs, like some software development costs that you would normally pick up for Section 41, and ASC 730 are going to get excluded on your adjusted ASC 730 amount. But there's also going to be some add backs too. The goal and what you should feel comfortable with, taxpayer, is if your adjusted ASC 730 amount is pretty close to what ultimately gets reported on your 6765.
Okay, and so, with all this information taken into consideration, what's the timing of this? Can it be done on an amended tax return? Can you go back on other tax years? Or is there, a starting point?
So there is a starting point, and the starting point is the actual issuance date of the directive, which was September 11, 2017. And it has to be an original, timely filed return after 9/11/17. So you cannot, in theory, go back and amend, and it cannot be on an amended return even if it was filed after September 11th, 2017. It's got to be an original, timely filed return, including extensions.
Okay.
So if you were really on the ball, you could have done 2016 if you would have had extended. I'd be shocked if anybody actually did that.
Okay.
But that in theory could have happened. All
right, good to know. Great. And so if we were to kind of wrap this up, what would be some takeaways that a taxpayer could take from this?
So takeaways are, if you are already using your U.S. GAAP financials and compliant with ASC 730, this may be a way to reduce your tax compliance burden, particularly in the event of an examination by the IRS, which is the whole purpose of this directive, really, is to reduce the administrative and compliance burden on taxpayers and the IRS itself. The IRS has been very resource constrained the last few years. They're still operating on the same budget they're operating on way back in the early 2000s. And so, the goal here was to reduce the audit burden on the IRS, not as many information document requests, not as much revenue agent time examining documentation, and also to alleviate some of the compliance burden for taxpayers. So that's the main purpose.
Okay.
Hopefully the directive lives up to that purpose. That's probably the biggest takeaway of this directive, is that it hopefully will ease administrative and compliance burden.
All right. Well, great. And so if anybody else has any questions as they watch this video, who can they contact?
They can definitely contact the two of us, David McCollum and Carolina Stevenson, or they can also reach out to the national leader of our credits and accounting methods practice here at Cherry Bekaert. That would be Ron Wainwright. We are all in our Raleigh office, but we do have CAM team representation across a good portion of the firm, and we would be happy to help you out.
Great. Thanks, Dave.
Thank you.